welcome everybody to the Leaders in Housing Counseling webinar. We have the one for April 30th, and this is part of our whole weekly series of doing webinars specifically around COVID-19 issues and challenges. And this one will be on the home buying process and how to do it in the current environment. So very glad, again, we have a strong turnout. We hope you are appropriately socially isolated, but also able to engage in the good work that you do, and we really do appreciate it. We continue to hear good and valuable reports of the work you're doing in the field, and we're, I should say, immensely proud of all the good things that you've been doing. And please be aware that lots of people know about your work, that it's, when we talk to people on the Hill, when we talk to policymakers, there's a deep respect now for the housing counseling work, and we very much appreciate the fact that you all are in the field doing the work and making sure that it gets done in ways that are both really valuable for consumers and meeting the needs, the safety needs of everybody involved. So we're going to do on today's agenda will be the legislative updates and Melody's report on what things are going on. Just a very short, quick update on the service or communication channels. And then we're going to dive right in. We'll have Julia Gordon from the National Stabilization Trust. She's now the president and CEO, and she's been a long and important voice in the in housing reform and helped write parts of Dodd-Frank, and has been hugely influential and helpful in her work continuing through into this crisis. She's going to give us a big overview of the home buying process and the challenges that are happening right now in the shrinking credit box. And then we're going to have Kelly Morocco and Amber Sabalos from Freddie Mac, and Brooke Adams and Christy Waters from Fannie Mae to really talk to us about the changes that have happened given the COVID-19 crisis and how the mechanics of getting a loan to closing, what the pieces are about getting the appraisal, home inspections, those kinds of issues, and some of the flexibilities that exist now, but also hopefully some ideas about how to actually navigate in this particular environment and keep some of our home buyer work alive, even though it's a challenging environment. And then we're going to have two practitioners, Sylvia Alvarez, who's been on our calls before with Housing and Education Alliance, and a long-term deep advocate and counselor who's always been on the forefront of a lot of the work, especially around closing mortgages. She'll talk from her experience, and Lou Savoca, who also is deeply experienced at DHIC, is also going to talk about what's working for them and how they're managing to get people through the whole process of underwriting and home ownership. So, and then we'll do a quick update just on membership, of course, and then our next call, which will be up in another week from now. So with that quick note, let's go over and talk with Melody about what's happening on Capitol Hill. Melody.
Thank you, Bruce. Hello, everyone. I'll be quick. Not a lot has happened between last week and this week in terms of legislative activity. The big news from last week was that the Paycheck Protection Program and Healthcare Enhancement Act, HR 266, was signed into law. Advocates and lawmakers are calling this Stimulus 3.5, just for those keeping counts of how many packages we've passed since early March. The primary part about this legislation was that it extended the Paycheck Protection Program, which allows, it provides aid to businesses to keep employees on payroll. That was about 300 and some odd change $1 billion to extend that program. The unfortunate part about the stimulus is that there's so many stakeholders and industries asking for cash. Lawmakers had to kind of pick and choose, and business was at the top of the priority list for now. So there was no housing provisions in that legislation. What we've heard from our partners on Capitol Hill is that right now all legislative packages, stimulus packages, will be focused on just addressing the needs right now. And so topics such as infrastructure and housing trust fund, we're hearing that's going to be pushed off to sort of post-COVID-19 recovery discussions. But we're still having those conversations now. If you're in connection with or reach out to your lawmakers, we urge you to push them on in considering housing counseling, and I'll have more about that for our next call. We were anticipating that the House of Representatives would be returning to Washington, D.C. Next week to sort of discuss additional negotiations for future stimulus packages. That is not happening. There were many concerns about the health of lawmakers, and they felt it best not to return to Washington, D.C. We do not have a tentative date of when they will be returning to D.C., and they're currently having conversations about how to have virtual committee meetings and votes, if you can believe that. But these are just very unique times. The Senate is returning to D.C. Excuse me, not D.C. The Senate is returning to session. However, they are focusing solely on confirming executive appointments and judges. So there won't be any hearings that we know of or that we've heard of around future stimulus packages. So in terms of the next stimulus, we just don't know. They're having those conversations. We've had really good conversations with House and Senate THUD appropriation staff, with banking staff, with financial services. Chairman Waters has been an excellent partner and advocate in those conversations for housing counseling. There seems to be universal agreement that given the housing crisis across the country around tenants and homeowners, landlords, homelessness is a huge issue, that everyone's in agreement that there should be a significant increase in funding for housing counseling. We're just still working out the details on the exact number and legislative language, as well as the mechanism for how to implement that and get the money out the door. So hopefully we'll have more to report on that next week and in the following Leaders in Housing Counseling calls. But for right now, that's just where we are, and I hope to keep everyone posted as more comes in. And I'll turn it back over.
Thanks so much, Melody. Very helpful. And Ellie, do we have Julia?
We do.
We do have Julia.
Okay, good, great. Okay, good. Let me just do one quick thing then. Good. So just a quick update on the servicer directories. So these are directories for, and actually the one that's probably most useful to everybody is the counselor one. That's right down on this list, and I think Ellie has circulated the link. It's on our website too, so you can go in there. The passcode will remain the same. Ellie's in charge of it, and it's going to continue to update it as we get more. But this will give you both the consumer portal and telephone escalation numbers, and also the ones specifically for counselors, so that if you have cases that you need to address directly to the servicer and need to be involved, you can use the telephone numbers or the email addresses, and there's escalation contacts for many of the servicers there as well. Still continuing to try to work to get more involved, and then we are very able to keep updating those. And certainly if you get leads on ones that we don't have, please feel free to share them. It's been sort of a team effort. A number of organizations have helped out in getting this to build this list. So we really appreciate everybody's efforts. So with that, I'd like to turn us over to Julia Gordon, who has been on our calls before. And I think, hopefully I've mentioned this earlier in the beginning of the call, has been a real leader in helping develop and reform legislation, had a role in Dodd-Frank, and a very valuable one, and in many of the housing challenges and crises of our time. And it's always been able to give us both a very high-level overview, practical, that gives you valuable insight into how we need to conduct our business. So Julia, welcome again. Glad to have you here.
I am always excited to be on this call, and thank you for asking me. So I'm going to talk about really two different things today. I'm going to talk about some challenges that we're seeing out in the field in terms of real estate transactions, and then I'm going to talk a little bit about access to credit generally. And I'll take whatever questions folks want. Unfortunately, I need to jump off the call a little earlier than some of the other panelists, so I think we may be taking questions for me before we move along. So I'll try to be brief, but mention a variety of things. My organization, the National Community Stabilization Trust, works with local partners who do acquisition and rehab of single-family homes. Many of these partners also do housing counseling or also do multifamily development, but our relationship with them mainly revolves around the single-family side, particularly as relates to home ownership, though some of them do single-family rental. In the past 6 weeks, I've probably spent more time talking to local partners than I ever have before, and it's been fantastic. But of course, the reason is that we're seeing all kinds of challenges across the country to taking vacant and foreclosed homes and renovating them so they can be put back to productive use for families as home ownership. The problems we're seeing are at all points in that pipeline. Even before the foreclosure moratorium that the CARES Act imposed went into effect, we had already seen the foreclosure pipeline mostly shut down in a lot of places because of the difficulties involved with courthouses that were closing, the inability to record deeds, the inability to trash out properties, all of that kind of thing. So that, and now with the foreclosure moratorium, which theoretically just applies to government-backed loans, but I think in many places is being observed across all channels, there's not much coming through in terms of inventory, new inventory for the partners we work with. For inventory that they're already working on, in some places, rehab is proceeding completely normally, and in other places, it's not. It really depends on the kind of lockdown orders in place and whether or not this kind of construction is considered essential, and then whether the inspection and permitting is able to be done virtually, over FaceTime or whatever, versus having to send an actual person in. So we are seeing a lot of delays through the rehab process. Some delays on the appraisal side, again, very location dependent. For both appraisers and realtors, there are some lockdown orders that specifically exclude them. There are some that specifically include them. This stuff is all really super local, so I can't really generalize in a way that helps all of you from across the country. But just know that these challenges in the inventory pipeline are there. And then there are challenges on the closing side, which I'm sure you guys have seen. I think a little over half the states do have the remote online notarization ability. Remote closings are happening in lots of places. In many places, they're happening seamlessly. In other places, they're not happening at all, or they're happening more like they're not online, but they're being done in a socially distanced way, whether in a room where people sit far apart from each other or, dropping things off at people's houses and proceeding in that way. We're not seeing, I am not hearing reports of closings being an across the board problem right now. it seems like many of our partners are still getting them done. And just to start pivoting to what I want to say about access to credit, we are starting to hear of some requirements popping up at the last minute that are related to the situation in which we find ourselves. For example, even though some of the major secondary market investors have actually loosened up on appraisal requirements, we're hearing of situations where an additional appraisal is being required to be done before the loan closes. And of course, in almost every instance, there are last-minute employment checks going on. My information is usually running about, 3 or 4 days behind real time, depending on when I talk to people. And, based on what FHFA has tried to do around continuing to take delivery of loans that go into forbearance after closing, I actually feel like we're going to see a lot more problems in this area start to pop up. And so that brings me to the second thing I wanted to talk about, which is what we're seeing in terms of access to credit and a constriction of the credit box, a reduction in the credit that's available out there for aspiring home buyers. This restriction comes from a variety of sources, and it's useful to think about all of them because there's like no one solution that solves all the problems at one time. In a crisis like this, generally what happens is you see capital markets slow down or freeze up. The capital markets are the source for, the money that's being used for the lending, and particularly, for certain kinds of lending that's more dependent on those private investors that want to be in the mortgage space. So we're seeing credit overlays being imposed at every level of the process. We're seeing investors impose credit overlays. We're seeing the secondary market, like Fannie and Freddie, either impose or not object to credit overlays in DU and LP. We've seen changes in the LLPAs such that the pricing spread between people with very, very good credit scores and people with credit scores under, say, 660, that spread is getting much bigger. We are seeing, and so a lot of that is coming from, I'll call it the investor/secondary market side. We are also seeing lenders do certain things, particularly as relates to what looks like penalties for loan originators who originate loans that go into forbearance quickly after they've closed already. And that's something we've just seen pop up this past week and could be chilling on a whole different level than the credit overlays. I don't know if it's going to cause some loan originators to just say, like, oh man, I'm afraid to originate to anybody who doesn't have like a completely airtight salary that I am 100% sure isn't going to go away. You're also seeing a significant difference between the behavior of banks and non-banks, or maybe a different way of putting that is similar behavior for very different reasons. The large banks, the Bank of Americas and JP Morgan Chases, who are seeing a lot of pressure in other areas of credit, auto, credit card, what have you, are are not putting a whole lot of energy into mortgage, and they don't want to see mortgage start to become a problem area like some of these other areas they're dealing with. So in many cases, they've put pretty strict overlays. I think Chase's overlays are the most well-known and public right now. Those aren't there because of liquidity issues. Those big banks aren't necessarily facing a liquidity crisis. They're just assuming they're not going to have a secondary market takeout, and so they're kind of reverting to their usual credit box for portfolio loans. The non-banks, on the other hand, many of them are having significant liquidity concerns. As more and more people go into forbearance, and I'm sure everybody on this call knows, we now have somewhere between 6 and 7 million people who have requested forbearance, which is an astonishingly large number. The servicers have to continue to advance payment to investors even when the borrowers aren't paying their loans. And even though at this point, all of the different categories of servicers don't really need to advance more than 4 months of payment. 4 months of payment is a not inconsiderable amount, especially for some of the larger non-bank servicers. The last thing I will mention layered on top of this is for GSE loans where there is private mortgage insurance. The private mortgage insurers are also reacting to the same concerns everybody else is. They certainly don't want to run into the problems they had during the financial crisis. They are already operating under a pretty significant set of requirements from FHFA about how much capital they have to hold. So they are better capitalized than they used to need to be. But they are seeing these new LLPAs come through, and it's affecting what they're able to do as well. So I'm sorry that was long, but there's a lot going on in this area, and I'm going to stop there and take any questions.
Thank you. Just really quickly, could you comment about the availability of non-QM loans? Someone said it appears that there's still a few investors offering outside of Dodd-Frank.
My understanding is a lot of the non-QM market is pretty shut down at this point. And, there was also a tiny QM private market that is, I think, pretty well shut down at this point. I have seen anecdotally, just in the trade press or whatever, certain lenders that seem to want to be, there to take advantage of, to fill the vacuum during this crisis. So probably if you look hard, you can find them. I would be very careful to look and see what their credit box looks like and frankly, what their solvency looks like. I should note there's a big problem right now in servicing in terms of the appetite that anybody has for MSRs, which are right now behaving a little bit like we saw the oil futures market looking last week, where in some cases the value of MSRs is going negative. So, there's definitely a business opportunity now if you want to both service loans and store barrels of oil. So that is also going to impact the part of the market that does lending without doing their own servicing.
Do you want to explain what MSRs are, Julie?
Well, that's just the value of holding the right to service a particular mortgage. and those values have their own market. And you know, the value of the mortgage servicing rights started to be impaired right away because of the drop in interest rates and the drop in mortgage rates. So this was something that was already happening pre-COVID when we started to see those rates get real low. And now in many cases, this layering on of uncertainties and concern about various risks is really impairing their value, meaning nobody wants to service your loan.
Nobody wants to service new loans.
Right.
Julia,
You have four?
somebody is asking if you just explain what non-QM is.
So Dodd-Frank established a safe harbor for loans that met certain indicia of safety or of responsible lending. Most of those indicia are product features, you know, such as fully amortizing loans or, you know, underwritten in a reasonable way. There is also in the existing definition of QM, which stands for qualified mortgage, a limitation on debt to income, which has not been that much of a big deal because loans that get sold to Fannie and Freddie have not been subject to that debt to income limitation, although as you know, if we see Fannie and Freddie tighten up, more and more loans will have to abide by that debt to income limitation, which is 43%, which for many of the clients you may work on would keep them out of being able to access credit. There is a market outside of Fannie and Freddie and out of lenders who will make loans that don't fit into this super safe category. The pricing tends to be different. The secondary market outlets tend to be different. But, you know, there has been in recent years somewhat of an uptick in lenders willing to make loans outside of that very narrow box, which is often useful for folks who have you know, credit issues or just whatever, they don't fit into the traditional credit box that well. But that market is, I think, drying up pretty fast right now. CFPB, by the way, is also rulemaking around the qualified mortgage. And before COVID happened, they were about to issue a proposed rule on changing the qualified mortgage definition. I think that rulemaking is going to get pushed out somewhat because of COVID, but that issue is still in play.
Okay, have you noticed that there's any difference in the way that credit reporting agencies are using people's credit behaviors in determining their credit scores? For example, one person said that their clients have seen their credit scores unaffected even though they've been paying off collections.
So I think I'm going to leave it to the folks at Fannie and Freddie who are going to talk to you to talk specifically about the effect of forbearance on credit scores or the lack of effect. And I am by no means a credit score expert. Because credit modeling works off of data, there is often a lag. And I know like it seems like it's been forever, but really it's only been like 7 weeks. And so I think it's a little bit unclear what we're going to see. you know, for people who have been taking advantage of getting a forbearance, that will help them in terms of not experiencing, or we hope not experiencing, a credit impairment from that angle. But again, it depends on what's happening from all of the other angles. At some point in the future, and this is pretty far in the future, we're going to have to work with credit bureaus to make sure that they are appropriately evaluating people's financial behavior during the COVID crisis, that they're going to look at it differently than they look at typical behavior, because we've never really been through this kind of exogenous shock before, where things are happening that really truly have nothing to do with the borrower's own you know, willingness, or, you know, to have been paying had they not lost their job. But I think that's like a in the future issue.
Okay, do you think that there will be an increase in FHA lending similar to during the financial crisis?
So Congress is looking at raising the loan limits for both FHA and the GSEs. They did this during the financial crisis. While I don't, right now nobody really knows the fate of any legislation happening beyond what happened last Friday. I actually would say it's pretty likely that they will raise those loan limits. That will solve the problem of the jumbo market having frozen up pretty much. And when that happens, especially depending on how much FHFA and Fannie and Freddie tighten up, I would say you would see a lot of, you will see FHA's market share increase as we did last time.
Okay. Let's see, I think we'll take one more question, Julia, because I know that you have to get someplace. What do you anticipate will happen after the forbearance phase lapses for non-QM loans? There's different information around about how private investors will agree to accept repayment after the forbearance phase expires. And this person says, thank you again.
Well, you are welcome again. So first, let me clarify something, because I've actually heard this on a number of calls I've been on lately. The private market is not the same thing as the non-QM market. Those are not synonymous. When we talk about non-government-backed loans, we're talking about all the mortgages held by banks in portfolio. That's the biggest category of non-government-backed mortgages. And then we're talking about a small amount of private label security-backed, mortgages that are in private label securities. So really, the non-government-backed mortgages, most of them are actually portfolio mortgages. Again, if you're working with lower income communities, you're more likely to run into those PLS loans. But many of those are QM loans. They're just not government backed. So that's the distinction now in terms of the CARES Act forbearance requirements, which apply to government backed loans, which is only to those loans either insured by FHA, VA, or USDA, or owned by Fannie or Freddie and securitized by Fannie or Freddie. If there's a loan and it's in Chase's portfolio, it is not subject to the CARES Act, and they can pretty much do whatever they want, both by way of forbearance and post-forbearance. On all of the loans, the CARES Act does not specify what happens post-forbearance. So this is now an issue of great interest, concern, and advocacy as we try to make sure that when forbearance periods end, consumers are offered affordable and sustainable options, and also that they're able to actually reach their servicer to be offered those affordable, sustainable options. So that's really what's, that's a big conversation happening right now. That's the conversation you'll hear people talking about, these lump sum repayments. Some of the non-government backed lenders have said on the phone to borrowers that when their forbearance ends, they're going to have to repay the whole thing. I've been looking into this a lot, and I actually think it's a very, very, very few servicers are really going to require that, but the messaging has been really crappy, and I think the understanding of line staff of how they talk about this tends to be confusing. Some of the documentation going out from servicers, I'm sure you guys have seen this. You know, I saw one letter where on the front of the letter it said, okay, thanks for signing up for a forbearance. Here's your payment schedule. And, you know, it said 000, and then it said like the total amount. But if you flip the piece of paper over, it gave you full details on 5 different possibilities for ways that you could pay that back in an affordable way. So making sure that clients are understanding these options is really super important right now.
Well, thank you, Julia, for your time. And I just want to say that there are so many thank yous in our chat box to you. So thank you again for taking the time to spend with us and talk to us about all this.
Well, you're welcome. And it was great to be here. And I'm sorry I have to jump. Bye-bye.
Great. Thanks, Julia. Ellie, can I just jump in for a quick minute, and then you can do the introductions after that?
Sure, go ahead.
I just want to say quickly that we are, many of you are hearing these stories and experiencing them with your clients right now about people being told they have to make a lump sum payment at the end of forbearance, or being given information that's just not helpful. A couple things. One is Ellie has posted a survey where we're trying to capture some of these stories and get them into the media. There's another survey that the National Consumer Law Center is circulating that'd be helpful to do it as well. And we are going to have a meeting with Kathy Kraninger on the CFPB in a couple of weeks, and we'll need some counselors to be on that in that meeting to talk about what they're seeing in the field. So please let us know if you've got good broad data examples, and this is all stuff that we want to really elevate so that people know what's going on out there. So over to you, Ellie.
Thanks, Bruce. So now we're going to move to our next set of panelists with Freddie Mac and Fannie Mae. We have Kelly Morocco, who is the director of Fannie Mae's credit policy division in single-family business at Freddie Mac. Amber Sabalos, I hope I said that right, Amber, pronounced your name right. She's an associate general counsel in the single-family real estate transaction group with Freddie Mac. Brooke Adams is a member of the Fannie Mae legal department, serving as legal counsel to teams supporting single-family lenders, the e-mortgage team, and the Making Home Affordable program. And Christy Waters is a director of credit risk at Fannie Mae, responsible for the underwriting and eligibility guidelines contained within the selling guide. And I think Kelly is going to start us off.
Hi, thank you. Good afternoon. I think we can go, let's see, let me check the next slide. Okay, great, thank you. So good afternoon. And first, I want to echo Bruce's appreciation for the housing counselors and your assistance that you provide to borrowers and homeowners. You are such an important partner in both home buying and the home ownership experience. And with that, I want to say thank you for inviting us here today to speak with you. It is an absolute pleasure to be with you. I have several colleagues with me. Amber Sabalis is on the panel with me and will chime in as needed. And she is with our legal department, as mentioned by Ellie. And in addition, Stacy Walker with Affordable Lending and Renee Crosby with Credit Policy are in attendance. So from all of us at Freddie Mac and also our counterparty friends across the river, Fannie Mae, thank you so much for your interest in this presentation today. As COVID-19 pandemic continues to affect many homeowners' ability to pay their mortgage, we want to let you know that we are absolutely in need of feedback. We appreciate finding out what is going on out in the market and providing temporary solutions while we face this. In addition, we're also making our solutions for the market that are practical and continue to support responsible lending. Under the guidance of our regulator, FHFA, and in close coordination with Fannie Mae, we are providing temporary solutions that I'll go over with you at a high level today to address market liquidity concerns. We're also making sure that our solutions for the market are responsible. In working in coordination with Fannie Mae, we have made a very concerted effort to align as much as possible to promote efficiency and stability to the market. We've been asked today to give you an overview of some temporary policy changes that some of which provide flexibility, some give you additional guidance, and some are looking for a little more updated information due to the crisis and ever-changing. And our focus today on what we're going to review with you is really getting the borrower to the closing table. So this is basically credit items. It's not servicing related policy items, which are after closing. I'll review the temporary policies that we've worked on jointly with FHFA and Fannie Mae, and then I'll pause at certain points so that Christy and Brooke from Fannie Mae can add any additional insights that they may have or areas where they may differ slightly from us. And then I'll give you resources. We have a lot of resources. I think both of us, and that's at the end of the slide, but I think both of us have provided links. And these resources, I think, are very beneficial to housing counselors as you're out there working in the market. And I really want to promote several of these. And I think we have live links for you, so they should be easy for you to access. And then Chrissy and Brooke, they also have the same similar type of resources, and I know that they will want to highlight theirs for your attention also. Okay, so as we develop these policies as fast response to assist families impacted and recognizing our business is a very interpersonal business, as all of you know, as you're out there dealing with the homeowners. And some of that has given us challenges and issues to get people to the table. However, we've also recognized as we are, putting things forward, we're all working at home, we're doing things more remotely than ever before. We've also realized that our recent advances in technologies are providing more opportunity to provide some flexibility, and I'll try to call some of those out as I move through. I would note that, these are items that we've worked on jointly with Fannie Mae, but not all lenders, have necessarily accepted our temporary flexibilities. So please, to check with your lender. I'll basically look at 10 policies. Some of them are a little bit longer than others. I'll pause for Christy and Brooke to add information where they differ in between. Some of these policies are very detail-oriented. Others are not. They're just friendly reminders, helpful hints. But I would absolutely encourage each of you to go into our COVID-19 links where we have our bulletins posted. We have our frequently asked questions that dive even deeper into this and answer a lot of your questions on these policies, because I can only go at a high level given the amount of time, and a lot of this information is on charts, and if you encounter this, do this, and if you encounter this, do this, and this is applicable here, and go to this form. So with that being said, please take this as an overview and go to the bulletins and the frequently asked questions for more detailed information. And again, this is all credit related. It is not servicing. So with that, let me dive in on some policies that we want to make you aware of. And effective immediately with applications received on or before May 17th, unless I note otherwise. The first one to speak about is employment and income. And in lieu of obtaining a 10-day pre-closing verification, we're providing flexibility that one of the following is acceptable. An email directly from the employer's work email identifying the borrower's name, title, and current employment status, or year-to-date pay stub from a pay immediately before the note date, or an asset account statement with payroll direct deposit for the pay period immediately before the note date. In addition, on continuance of income, we highly recommend, because it's not only getting a borrower into a home, it's sustainable home ownership. We want to promote that our borrowers are getting in and that they can sustain their home ownership. So we highly recommend the practice of doing extra due diligence, that the borrower's information is accurate, up to date, and they have the ability to repay the mortgage. With that, I'll pause and see if Christy or Brooke, Amber, have anything else to add.
Hi, it's Christy Waters. Just want to echo, thank you for having us. Thanks for all that you do. And actually, no, because we had to work so closely together under the direction of FHFA, I think it's great if you want to just go straight through these.
Okay.
I doubt there'll be many differences. We can touch any minor differences, which would be very technical in nature and probably best covered by the FAQ. But thank you so much for doing this, for going through it.
Okay. Absolutely. And maybe at the end I'll stop, because if there's anything you want to add, that would be great. I just didn't want to roll through it without you, Christy. Okay, so next I will take up appraisal and property related flexibilities and guidance. And as you know, all of you know and has been noted, there is some issues with interior inspections. And so we are allowing exterior only inspection appraisals or desktop appraisals in lieu of interior exterior inspection appraisals for loans with certain characteristics. However, you must note that you still need sufficient information to be able to complete that appraisal. We've also worked with Fannie Mae to provide revised documents to accompany the appraisals so that appraisers can confidently rely on information provided from the homeowner that could help them in obtaining the necessary information to complete the exterior or desktop appraisal. So we have worked on new scopes of work, assumptions, and limiting conditions and certifications. And this allows, an example of this would be a homeowner to provide some photos. This is a place where I would encourage you to look at the webpage for guidance, our COVID-19 webpage for guidance and instructions, because there are, single family, co-op, condo, 2 to 4 units, manufactured housing, new construction. They have different forms that are required. So more information in the bulletins. Virtual inspection. As a result of frequently asked questions, we've clarified that virtual inspections may be used to augment data for the desktop or exterior-only appraisals. However, in many cases where an interior inspection is required, a virtual inspection is not suitable in those instances. And I'll give you an example here. I do want to point out on our renovation program, Choice Renovation, where repairs are subject to completion, there are 3 areas of either flexibility or guidance that we have noted here. And this is one where we require at final closeout a Form 442, which requires an interior and exterior inspection because it's your final inspection, and we cannot waive that there. So guidance there. We're also providing information that we understand that our guideline is that construction should be completed within a 12-month period, but given the situation that we're in today, we understand that that may not happen due to construction being delayed, inspections being delayed, courthouses, recording offices being closed. So we do have on the bulletin, an email where you can request an extension. And then also to note, if a loan goes into forbearance prior to completion of renovation, continuation of distribution of the draw funds are permitted during the forbearance period. In addition, on our Green Choice program, and that is our energy efficiency program, we do allow for, in lieu of the 442 form, they can do a signed letter from the borrower confirming the work is completed, along with photos, paid invoices, permits, or other substantially similar documents are acceptable. One other thing in the appraisal space that I want to make you aware of, we have something, and Fannie Mae's is similar, an automated collateral evaluation. We call it our ACE, and it waives the requirement for appraisals. And we are highly encouraging lenders to accept appraisal waivers when they're offered. In addition to that, we've expanded it to include cash out and no cash out. And you can read more about that in our bulletin. I also wanted to share a little bit of data that I just received on these appraisal flexibilities. And, this is very new. It just came out, and this data is through April 15th. But on purchases, we're still seeing 77% are doing full appraisals, 17% are doing desktop appraisals, and 4% were doing exterior. And on refinances, 80% were doing full and 16% were doing exterior. So you are seeing that people are taking advantage of these flexibilities. However, it also looks like full appraisals are also being able to obtain in many areas. Okay, then age of docs and asset docs. All income and asset docs documentation must be dated no more than 60 days prior to the note date. There are some exceptions to that, like if there are quarterly statements. In addition to that, electronic income verification from a third party now must be no more than 60 days prior to the note date. On our bulletin, there's a list of standard docs. I would refer you to that to get details. But we are looking in this instance to verify both income and assets closer to the note date. In addition, on self-employment, our current guideline requirements, we require verification of a current business is in existence no more than 160 days prior to the note date. Now we're asking for additional steps to be required to ensure that the business is operating within 10 days of the note date, given the volatility of the market. And this can include current work contracts or business receipts within 10 days, a lender to certify that the business is open, or the business website showing that the business is currently operating. In addition to that, on assets, we did provide some additional guidance around stocks due to market volatility, and we are asking if the borrower is using down payment, if they're using stocks for down payment and closing costs, that they provide evidence that it has been liquidated and that the borrower is in receipt of funds. And in addition to that, if they're using stocks for their reserve requirements, that they use no more than 70% of the balance. And all of this, of course, is due to the market volatility that we're seeing. On to the next one, the power of attorney. I want to give you some overview on this, but again, I want to encourage you to dive into the bulletins that are on the link that's provided. Look at the frequently asked questions, because as I start rolling through this, you're going to see where I say, if this, then that, but if you do this, then that. So I think it's very beneficial if I keep it at a high level, but you have the documentations that you can refer back to. So power of attorney, follow the chart provided in the March 31st bulletin. It's 2020-08 for specific requirements. Please note that a power of attorney is allowed per our section 6301.4 in cases of an emergency, and effective for applications received dates on or before May 17th. Again, please look at the frequently asked questions. Power of attorneys are allowed to close a mortgage or e-mortgage, except not allowed for cash out or Texas Equity Section 50. Again, please check the chart provided in Bulletin 2020-08. Initial and closing docs in cases where a borrower is unable to personally sign or electronic signature of POA could be used. There are special instructions for the Form 65. A couple other details, like who, a person who is family, personal, or has a fiduciary responsibility may be the attorney, in fact, for the borrower in a POA. In addition to Section 6301.4, individuals employed by the title insurer or title agency, and again, follow the details for additional requirements. A POA must be notarized for purchases, but not required for no cash out refinances unless required by applicable law. There's an additional requirement about discussing a POA with a borrower. That is not required on a no cash out, but it is required on a purchase, that there not only needs to be a discussion, but an acknowledgement. And again, I would say go back to the chart for further details. We also give additional details on remote online notary, and you can see our requirements again in the 2020-08 and section 1401.16, where we have permitted states listed for use of remote online notarization under certain circumstances. There's additional information on electronic records and signatures, borrower's signature on the note, and then also a reminder on title insurance that we understand that a lot of the recording offices are closed, but a reminder that 2006 Alta Loan Policy Risk number 14 covers matters between closing and recordation. So just bringing that to your attention. Additional flexibility that I wanted to note is on condo project review. On Freddie Mac owned loans, we have provided some flexibility on no cash outs that are primary residents. And in addition to that, recognizing the issues with HOAs not having their budgets completed and potential difficulty obtaining project documents, we've provided some flexibility in those areas too. And those are noted on Bulletin 2020-11. If you will switch to the next slide, I will start going over our temporary flexibilities around forbearance. So forbearance, suspension or reduction of mortgage payments, typically 6 to 12 months. Our current policy is that we generally do not buy these loans as being eligible to Freddie Mac per our guide. However, we have received requests from the market to provide support and guidance in handling these mortgage and to assist in providing liquidity to the market. We're making the following temporary changes. Once a loan is closed and you have underwritten the loan in compliance with the selling guide, after closing but before delivery to Freddie Mac or Fannie Mae, the borrower reaches out and attests to and requests forbearance, then the following applies. This is for note dates on or after February 1st and on or before May 31st. Mortgage is considered in forbearance if, 1, a request for forbearance and attest to a COVID-19 hardship, or approved for a forbearance plan. And just to note, a borrower who just inquires without a request is not necessarily a mortgage in forbearance. These are for purchase and no cash out refinances only, and the borrower cannot be more than 30 days delinquent. In addition to this, I want to let you know that there are pricing implications here. There are pricing fees that are added in addition to our Exhibit 19 fees that go across different mortgages. It is the fees for the forbearance will be 7% for non-first-time home buyers and 5% for first-time home buyers. So with that, I will pause, see if Annie has anything to add, and then I would like to touch on the Freddie Mac resources that are available prior to opening it up for questions.
Yes, this is Christy. We don't have anything to add other than just looking at our FAQs. Both of us have great FAQs, and within those FAQs, there are even some job aids and tables to make it easier to navigate. But don't have anything to add, Kelly.
Okay. Okay, thanks.
This is Brooke. I
Okay,
actually do want to add one quick thing. Sorry, I just wanted to make sure.
Absolutely.
Flipping back to the remote online notarization, both GSEs also put out an FAQ regarding remote ink signed notarization, given some of the executive orders from governors. And that's both found in our FAQs. I just wanted to make sure we touched on that.
Perfect. Thank you so much. I appreciate it. Great. So want to touch on resources. In both Freddie and Fannie, we both have our main COVID-19 resource page. And I think if I've said one thing in this presentation, it's please, please, please look at the bulletins. That's where the details are, and further explanations in our FAQs for both GSEs. So this is our link. It should be a live link. It is a one-stop shop to our tools and information that we're providing, both in our selling and servicing. I only went through selling today, but there are other bulletins in there on servicing that provide you additional information. Also wanted to point out that there are several webinars that you can gain access to. There's also a Help Starts Here to assist. It's an interactive, and it assists the homeowner ask the right questions, documents that are needed, how to avoid scams. I went through it, I ran through it, I pulled up all the different definitions, and I thought it was very helpful. So I wanted to let you know that's there. My Home, some things that are out of the COVID or, some other resources. My Home, it gives rental information. Are you ready to buy? It gives you homeowner information. It also talks about our borrower help centers and our borrower center network. These were established in the previous crisis and are still active. And I know y'all are all familiar with them. And those are great resources for homeowners that are having difficulty paying their mortgage. So absolutely want to call that out to you that it's still there and available. In addition, we have our Credit Smart, which is our financial capability education tool. We have our Credit Smart Homebuyer U, which is our homebuyer education tool, which was just completely revamped. All of this is free. It's on a multimedia platform. It's easy to access. And also, there was one other thing that came about this week that I heard about. I wanted to bring to your attention that we have been working with FHFA and Fannie Mae to develop a website. It's mortgagetranslation.gov, and it provides both origination and servicing documents in English, Spanish, and Chinese. And I think they mentioned it's coming out in Vietnamese soon, so that might be also beneficial to you. And I would also want to mention that our frequently asked questions, and Fannie Mae's too, I'm absolute certain, are updated regularly. They're updated when we're providing new bulletins out to the market. When we're receiving feedback, we go in, and if it's something we can handle with an FAQ, we'll put it in there. So please refer to that frequently. And also I want to thank you. We all want to thank you for continuing to work with us. We appreciate your feedback, your sharing, your questions that you've raised. It's so important, and to help us better understand the challenges in the industry, what you're facing. You have direct experience with the borrowers, with certain localities, with what people are seeing. So you're a very important partner to us. We know you have more questions. We are working quickly. Just to give you an idea, we typically come out with one selling bulletin, one servicing bulletin per month. We are coming out with them every week. Sometimes it's 2 times a week. We are in this with you. We are trying to provide, to take your feedback and work as quickly as we can to address possible solutions. With that, we want to provide liquidity and stability to the market, but we also have to ensure responsible lending. We will continue to actively monitor the developments in the market, work with our regulator and Fannie Mae to address these and issue additional guidance. And with that, I'd like to thank you so much for your time today. And I'll turn it over to the other panelists or open it up to questions.
We do have a couple of questions. Let's see. Somebody is asking about whether or not you have documentation available and resources available in Korean.
You know what, we will have to get back to you on that. The only thing that I am aware of that I was notified of this week on the originating and the servicing documents was the English, Spanish, Chinese, and Vietnamese. So they did not mention Korean, but I can certainly take that back and let them know that that is something that is needed.
Wonderful. That I think that would be great.
Okay,
somebody, I think you talked a little bit about this, but I'm just going to ask the question. Somebody is just asking for a little bit of clarification around the rules for using online notarization.
I'd be happy to take
Brooke?
that one if you want me to,
Okay.
Kelly.
Sure. I'll let somebody else talk for a minute. Thank you.
No problem. We are aligned on this, so it's certainly not an issue for me to take this one. But the rules per se, I think she's probably, or whomever is asking, is referring to power of attorney, and you are permitted to use remote online notarization in order to obtain electronic notarizations for certain powers of attorney. If it has to be recorded, there are different rules for that power of attorney. And then we separately have a set of technical rules, including the terms and conditions and system requirements for remote online notarizations to be performed. So I would suggest taking a look at both of the GSEs have the same requirements on both of these. We're aligned completely. And if your borrower needs to obtain a power of attorney and needs to use either remote online notarization for an e-notarization or remote ink signed notarization, both are covered in the bulletin and lender letters, and remote ink signed is covered in the FAQs.
Okay, thank you. I think we have one more question. Somebody is asking for clarification around income and asset documents. Are you saying the income and asset documents are temporarily no longer good for 120 days? What about appraisals? Are they valid for 120 days as well?
It is temporary guidance as far as the looking for a shorter term on the income and assets. The appraisal, I do not see that they have made, collateral has made any changes, that these are less than 120 days.
Okay, and we got one more question in. Will there be any consideration to refinance homeowners who are still underwater on their mortgage at the lower rates due to COVID-19?
I'm happy to take this one. This is Christy. both Fannie and Freddie Mac both have a high LTV refinance option for borrowers whose property values are not within our standard LTV requirements. So I would say, please refer to those guidelines. They have not changed, other than the age of docs and some of the contractions here for COVID. Those guidelines are out there to help those borrowers who maybe are underwater and still able to refinance.
Great. Well, I want to say thank you all very much. That was the last question. If anything comes through that is specific to Fannie or Freddie after you all leave the call, I'll just forward to your emails. But thank you again.
Great.
We really appreciate your time.
Great. Thank you for having us.
Thank you. Bye-bye.
Great. So now we're going to move to a couple of housing counseling organizations. We're going to talk about what they're doing because they are continuing to close mortgages. And we're going to start with Sylvia Alvarez, founder and executive director of Housing and Education Alliance in Tampa, Florida. Sylvia.
Hi, Ellie. Hi, everyone. These are definitely different times that we find ourselves in. And I appreciate all the information that was recently shared by the other panelists. Yeah, we are still closing loans, and I checked with many of the realtors and the lenders that we work with, and what they're saying is they've never been busier. And they're showing homes virtually. They're closing out in parks and benches with masks on and gloves on, and giving the signers a pen and telling them to keep it. And they have actually seen an increase. And I started to think, why is that now? And it has to be that people are sitting at home and don't have a whole lot to do. So perhaps buying a home was on the back burner, and they've got a lot of time. So they're online and they're looking for houses. But we've really not seen a decline. We immediately had to go and start working remotely. Thank goodness we had a good plan, a disaster preparedness plan. Being in Florida, you have to have one. And so within 24 hours, we were all working remotely, which is something that we really were toying with for several years, but didn't think it was possible, or it was too difficult to actually bring about. But I think, the COVID-19 has forced us all to do things in a different manner. And I really feel that at the other side of this, even though there's going to be a whole lot of sadness, I really think that on the other side, we're going to be more efficient. We're going to be able to handle tasks in a totally different way. I think in a better way. Think of all the things that have been affected. Pollution is down. Maybe we don't need to be driving to all these meetings that we drive to all the time. Maybe what we need to do is do more Zoom visits. So I really think that this pandemic is going to change our lives completely going forward. But I think it's going to be for the better in the long run. But really shocked that our phones have not stopped ringing with people, trying to apply for down payment assistance. One issue, though, that has sort of put a damper on moving forward is that a lot of the municipalities that have DPA have actually put them on pause for now, understandably. But what we're telling everyone, if buying a home is something that you want to do, then you really need to start getting ready now, so that when things return to the new normal, then they're ready. So we are really pushing homebuyer education. We have our online homebuyer education course, Home Track Online, which is now also in Spanish. So we're continuing with that. We're counseling using Zoom and using Skype, and I think Team is the one that Microsoft has. So things have gone on as usual. I will say that we're getting about 3 to 7 calls a day for people who are wanting foreclosure help. They've lost their jobs and they're not sure, what their options are. So what we're doing is we're taking everyone's names and contact information. And once we have a better feel for what we're doing going forward, we will be reconnecting with all of them and hopefully trying to help them. I just hope that there's funding to pay the housing counselors to do this work. So that's what we have seen here in Tampa. People are still wanting to buy homes. It's the American dream. Maybe a lot of them have lost hope, but they still have that dream of being a homeowner. So
Sylvia, can you talk a little bit about the nuts and bolts of how you are actually walking through a closing with people, given the need for social distancing and the potential for some of the online work?
Well, none of our staff is actually in person visiting with anyone. Everything is being done remotely, and everything, for example, if when we have to review documents, if someone's closing and they ask us to review the documents, well, they're going to send them to us. They'll scan them. One of the counselors will review them and make comments, and hopefully everything is okay, and then they move forward. But business as usual is just that we've removed the in-person contact. It's still personal because we can see them on the screen.
And are you seeing any difference with the way that it all happens at the closing table?
Well, I think everybody has masks on and everyone has gloves on. Most of the closings we are recommending that they do outside. You know, go find a picnic table somewhere where you can sit on one end and someone else sits on the other. But that's what we're recommending to the people that have worked with us and are closing with us or through our programs. And people seem to be, I did send you that one picture of how one of our closings was happening out in a park, but that park was open, so that was a good thing. Anyway, we've had to adapt, and I think this is only the beginning. We're going to have to be doing a lot of adapting going forward. So I think patience needs to be definitely impressed upon anyone who calls. We tell them, please be patient. We will get back to you as soon as possible. The foreclosure calls are increasing. I'm very concerned about that. And we will be helping out as soon as we have a clearer path as to what that's going to look like. And you know, Tampa was one of the epicenters of the foreclosure crisis, and I was really hoping we would never ever see anything like that again. But this one feels different, and it feels different because of the not knowing. But hey, we've been tough. Look at all the things we've gotten through. We're going to get through this as well.
Great. Thanks, Sylvia. So we're going to take a few minutes to talk now with, and hopefully, Sylvia, you'll stick around in case there's some questions.
Okay.
Now we're going to hear from Lou Savolka, who's the housing advisor at DHIC Inc., the Homeownership Center in North Carolina. Lou. Lou, if you're talking, we can't hear you.
I think he's just got to unmute.
Well, unfortunately, we are not hearing him. So, Sylvia, I will say somebody is asking if you could provide a website or an email address. Somebody would like to reach out to you to just get some thoughts about and some insight on how to get started on closings if they are interested in doing that. They're in Virginia.
All right, sure. Actually, give them my personal email. It's salvarez, ALVAREZ, at HEAUSA.org. Closing is just a little different nowadays, just a little bit different. We all look like we're ready for Halloween, I think.
Hi, Ellie.
Lou, yay.
I got disconnected. I am so sorry. Please forgive me.
That's okay. Go ahead.
Okay. Well, thank you very much, Ellie, for inviting me to speak. I'm Lou Savolka with DHIC, Homeownership Advisor. And DHIC is a nonprofit organization dedicated to the development of high-quality housing communities in the Triangle region of North Carolina. We are located in Raleigh, and the Homeownership Center is a separate business unit within DHIC. And I'm, again, a homeownership advisor with a bent toward helping clients with accessing down payment assistance programs and helping them throughout the whole entire process. So in regards to your earlier point, Ellie, about nuts and bolts of what we're doing and what we're experiencing, I kind of broke it down to a couple sections, and I know we're past 2:30, and I'll try to go as fast as possible. At initial contact or conversation previously, this is surrounding the client, the borrower, and the lender. We would have face-to-face conversations, or would be conversations over the phone. Documentation would be either handed in, maybe a recommendation on how to move forward with purchasing, and that was in the past. And so now with COVID in place, the initial conversations either by phone or virtual, like using Skype, Google, or Office, Zoom. Majority of the time, documentation is emailed or securely faxed in. We review documentation, and then we move forward again with either a Skype call or phone call or recommendation at that point. So that's the initial conversation. At pre-qualification with a mortgage lender, again, our previous conversation was over the phone or in person with the MLO. Qualification for a mortgage was completed in a pre-qualification handed to the borrower in person or sent via email. And then borrowers would receive initial disclosure, including loan estimate in person or, again, via secured email. Now, lenders are encouraging potential clients to complete an online application first. And then the pre-qualification is handled by that format, either by phone or virtual call. And then the documents, again, are either secured email or sent to the borrower by fax. Next step, at the offer of purchase of acceptance and processing the loan for approval. Previously, all negotiations were either in person, maybe visiting the home of interest. Maybe the client provided documentation to the lender directly in person or via secured email. Now, finding clients are visiting home through the internet and looking at the home listed on the realtor website, including pictures of the property, home and rooms. A lot of the negotiations are done by phone and email. Documents are perfected with e-signature or DocuSign, so that's how they're being handled. And then with final approval, as it's initiated through the lenders, previously mortgage loan officers would talk to the borrower by phone or provide decision, again, via email or fax. The borrower completes the final task provided, and during that process, the appraisal is completed, sometimes in person. Of course, that's changed. We learned that today, that's changed. Now the MLO communicates virtually by phone or by Skype or some other virtual method. Borrowers complete tasks, including homeowners insurance. Everything is requested for them at closing. And then the final disclosure is also reviewed prior to closing, either by email or fax, and reviewed. And again, all three parties are involved in this process, the homeownership advisor, the lender, and the borrower. So getting to the closing table. So previously, all attorneys used to be able to review documents in advance with the client. Normally in North Carolina, and specific to North Carolina, borrower signs at the closing table, which sometimes the sellers are present. Then the borrower obtains their keys and moves forward. Now attorneys have certain procedures, and some of the notices I've seen that come across with new policies because of COVID, only buyers and sellers will access the office at closing time. So they're not going to allow like children or family members or any other moral support. If the borrower doesn't feel comfortable, then there's mail-aways. Some of the attorneys are willing to do mail-aways. There's no picking up of checks. All checks will be dispersed via FedEx or sent out to the realtors and the lenders. Dropping off earnest money and documents and info sheets. A lot of that information is through a door slot, or maybe even faxed to them or emailed to them. So majority of this is because of COVID-19, and so a lot of the different parts of the entire transaction has to be able to be flexible. So with some final thoughts, Ellie, and to the rest of the folks on the call, some practical ways that what we do as far as the process is concerned, we try to do lots of extra communication. So try to anticipate the need before it is requested of you. By trying to anticipate that need, you're answering the question before it's asked. So sometimes it's maybe very difficult, especially when you go through a transaction that's difficult already. But if you try to anticipate and try to get in front of what is going to happen, a lot of times that whole process is a little smoother. Next, deliver good news quickly and bad news even faster. Nothing is worse for a borrower than wondering what's going on with their file. So we try to do that. If something's not going the right way, it's going squirrely, then we try to communicate with both the borrower, the lender, whoever's in a transaction, see what can we do to try to help alleviate what the issue is. And then lastly, patience, and more patience. During this process, a lot of listening. Borrowers are very, very anxious during this time. Having a trusted advisor by their side makes all the difference in the world to them. Had multiple clients who had maybe a spouse who was working, and then all of a sudden during COVID, the other spouse lost their work, but we still were able to find a way to help them purchase the house with other alternative types of financing, like down payment assistance. So each situation is different. In each situation, it's recommended to listen to the borrower very, very closely to what's going on. And by doing these little steps, we found that the whole process a little bit smoother. So I hope that helps, and I'm happy to answer any questions.
That's great, Lou. Thanks. One thing that came through is somebody similar to wanting the information from Sylvia. They would like your contact information, if you don't mind sharing your email address.
Sure. It's simple, lou@dhic.org. That's LOU@dhic.org.
Great. Well, I think that that's really helpful from both of you to be talking about how you're actually still doing this on the ground. It's good to hear that things are actually still happening. And with that, Bruce, I'm going to turn it back to you.
Excellent. Thank you, everybody, for your participation here. Just going to make a quick plug on the membership that we really appreciate everybody joining, and we now continue to get renewals, even in what must be a hard time for organizations. We appreciate that. If this isn't the time for you, we understand pausing, and we're obviously going to work with everybody. But it's been heartening to see the amount of support we're getting. We appreciate that a lot, and we'll continue doing this work, and as well as doing the work in Congress to try to get more funding, which has come up. Sylvia brought it up again, and we are working madly to try to make this all happen. So next week, we're going to have our next session. And Ellie, remind me what it's going to be on?
It is going to be on rental.
That's right. So we're going to hear from some practitioners about doing rental counseling, and we will hopefully, partly what we're interested here is we did one session on the eviction moratoria and how they work, and heard from one leading group a few weeks ago that's been doing tenant counseling for years. We're going to assemble another group of tenant or rental counseling counselors with the idea that we want to understand some of the models of what people are doing. We hope that this would be both relevant to what's going on right now with all the pressures on renters, but also the idea that there might be models that make you think that they might be able to continue doing rental counseling going forward. And we'll do several sessions around rental issues doing all this. So with that quick note, we'll talk to you again next Thursday. Hope everybody's doing well, and appreciate all the good work you're doing. Thanks so much. Bye.